It's not uncommon for traders to enter the world of options trading without having a clear grasp of the options technique that are at their disposal. There are a number of options methods that reduce risk while also maximizing on the investment. This video will explain to you what stock options are and what are the top stock options methods that you should consider. Stock options, the right but not the duty to purchase or sell any underlying stock, is provided through stock options in the financial markets. In essence, a stock option allows an investor to gamble on the growth or fall of a certain stock by a specific date in the future by purchasing the option. As a risk management strategy, major businesses often acquire stock options, but options allow investors to bet on stocks, which increases their risk. Features of stock options. Styles. They come in two styles, American and European. Anytime between the purchase date and the expiration date, American options can be exercised at no cost to you. Unlike American options, European options are only exercisable on the expiration date. Expiration. In addition to placing bets on a stock's price increasing or dropping, options also allow traders to pick a particular date when they believe the price to increase or decrease. The expiry date is the day on which the product is no longer valid. Traders can price the time value of a put and a call option using various option pricing models such as Black-Scholes model. Strike price. Whether or not an option should be exercised is determined by the strike price. When it comes to expiry date expectations, this is where a trader anticipates the stock to be. It is possible to buy calls for a specific month and strike price if a trader believes that IBM will rise in the future. Contracts. An option contract represents the quantity of options that a trader may be interested in purchasing. For example, if you buy 100 contracts, you get a premium equal to the price of 1. A trader buying 5 January IBM $150 calls for $1 each contract would spend $500 in this scenario. Puts can be purchased by traders who believe the stock will fall. Premium. It's possible that a trader might now possess 5 calls for $150 in January. Even if the current stock price is higher than $150 by the expiration date, the trader has the option to execute or purchase 500 shares of IBM stock at $150. Options expire worthless if the stock is valued less than $150, meaning the trader has lost the full money invested to acquire the options, commonly known as the premium, when they expire. Trading options. According to the technique a trader is employing, options can also be sold. As an example, if a trader believes IBM shares will rise, they can purchase a call or sell a put. An IBM January $150 put seller would get $500 if he sold 5 puts. Option expires worthless at a price above $150, enabling the put seller to pocket the whole premium. While this is not a guarantee, a seller would be required to purchase the underlying shares for $150 if its closing value falls below the striking price. Since the trader now holds shares for $150 per share despite it selling at a lower level, he would lose the premium and additional capital. Types of stock options. The two types of stock options are call option and put option. Investors can select between a call option and a put option when trading stock options. If you buy a call option, you're wagering that the price of the underlying stock will grow in value. In a put option, the investor wagers on a declining stock price. A contract of 100 shares of an underlying stock is acquired as an option. As soon as a contract is written, it establishes the strike price, which is the price that the underlying stock must reach in order for it to be in the money. Stock price and strike price are used to establish an option's value. Top 8 stock option methods. Here are the top 8 stock option methods that you can consider. Number 8. Long butterfly spread. 2 distinct positions or contracts were necessary in the preceding techniques. An investor will combine a bull spread strategy and a bear spread strategy in a long butterfly spread utilizing call options. Aside from that, there will be 3 distinct strike prices. It's worth noting that all of these options have the same underlying asset and expiration dates. Number 7. Long strangle. As part of a long strangle option strategy, the investor purchases both a call option and a put option with an expiration date that is out of the money. These investors anticipate the underlying asset's value will change dramatically, but they aren't sure in which direction it'll go. Number 6. Long straddle. Investors use the long straddle option strategy when they buy both a call and a put option on the same underlying asset with the same strike price and expiration date at once. If you feel the price of the underlying asset will move considerably out of a certain range, but you aren't sure in which direction, this is a good approach for you. Investors may theoretically make limitless profits with this approach. However, the maximum loss that may be incurred by this trader is restricted to the aggregate cost of both options contracts. Number 5. Protective collar. A protective collar strategy involves buying an out-of-the-money put option and writing an out-of-the-money call option at the same time to safeguard your investment. Asset and expiration date must be identical. In many cases, investors employ this technique after a long position in a company has seen significant gains. Due to the fact that the long put helps to lock in the future sale price, investors might benefit from downside protection. As a result, they may be forced to sell shares at a higher price, therefore forfeiting the opportunity to make more money in the future. Number 4. Bear put spread. In addition to the vertical spread, the bear put strategy is another type of vertical spread. Investors buy put options at a certain strike price and concurrently sell the same amount of put options at a lower strike price in order to achieve this strategy. These two options have the same expiration date and are required for the same underlying asset. Investors that are pessimistic on the underlying asset and predict its price to fall utilize this technique to their advantage. As a result, the approach has a limited potential for both losses and gains. Number 3. Bull call spread. This technique involves simultaneously buying calls at a certain strike price and selling the same amount of calls at a higher strike price. As for the underlying asset, each of the call options will have the identical expiration date. A bullish investor would utilize this sort of vertical spread strategy if he predicts a slight rise in the price of the underlying. It allows the investor to limit their upside potential on the deal while decreasing their net premium invested, compared to buying a naked call option outright. Number 2. Married put. This technique involves purchasing an asset like shares of stock and concurrently purchasing put options for the same number of shares, which is called a married put strategy. Every contract is worth 100 shares, and the person who holds a put option has the right to sell the stock at the strike price. When investing in a stock, an investor may opt to utilize this approach to reduce their negative risk. As an insurance policy, this technique provides a price floor in the case of a significant decline in the stock's price. Number 1. Covered call. The simplest way to trade calls is to purchase a naked call option. Also, you may use a basic covered call or buy right arrangement because of its ability to create income and eliminate some of the risks associated with holding a single stock. This is a widely popular strategy. Your shares must be sold at a specified price. The short strike. This technique involves buying underlying stock as usual and concurrently writing or selling a call option on the same stock in order to implement the approach. As a result of this, the investor's short call is covered by his long stock position. If you have a short-term investment in the stock and a neutral opinion on its path, the approach may be the right one for you. Alternatively, they may be aiming to make money by selling the call premium or to protect against a possible drop in the price of the underlying stock. We hope you liked this video, and if you did, don't forget to give this video a big thumbs up. Comment which method you liked the best. Thanks for watching.